this image of you in my mind on holiday of sitting mournfully looking out the window at 4 p.m. GMT on it's Monday today, isn't it? Monday, going, I'd rather be here with the boys telling terrible dad jokes.
100%.
We missed you.
I did. I left the sun. It gets a bit hot for me in Cyprus, so I left the sunbed, usually around 3 o'clock, and Amanda came back to the hotel room. I like the hotel room because it's air conditioned. I can see the sun outside the window, but feel comfortable. And I sat there on my laptop doing some work. Pina colada next to me.
Oh, it's the dream.
I love a pina colada.
And Amanda came in and she said, I don't know whether to be even more in love with you or to hate you even more. I was like, well, I don't. It's, that's just natural.
It's a trap.
If you're gonna rank like the quality of drinks that you have, so they sort of say like a 7 p.m. gin and tonic before.
Can we get all this, please? Because this is very much the content.
To me, it's high up. I would say that the Thursday at 5 o'clock, I'm really thirsty, let's go to the pub quickly, is a good drink. I would actually say the best drink is the 6 p.m. on the hotel balcony after a day in the sun. You just had a shower and you're about to go out for dinner, just sitting there taking the world in, often checking emails. That's when I do it. I think that's one of the best drinks.
Sundowners.
Yeah.
Can I have an honourable mention for roughly 4 p.m. on a Wednesday back in the uni days after a hard fought away win against Man Met or something? Beer in the shower, lovely.
That's a good.
There's an image for you to start off on.
That's good.
That's up there.
I've got a new laptop because I keep breaking them. How do I turn off the settings on this?
Right. When you're doing that, I'll intro the show if that's okay with you. Welcome back. We are on episode 16 of Taking Stock After the Bell, episode 16. Johnny Raymond, James Hughes, the usual gang, myself, David Henry, investment manager as well. All sorted?
All sorted.
All sorted. Full steam ahead. Here we go. Let's kick off with GARS because we've already sort of touched on it. Yeah. Standard Life, isn't it? Standard Life. Life GARS funds.
Global absolute return
is going to close. This was a big deal when it launched. When was it? 2011, I think. 2012. It got to 53 billion of AUM, casual, and it's shutting with a value of 1.4 billion. So that's been a heck of a turnaround. What do we think about this? I've got some thoughts, but I've got a tendency to step on your guys' toes before you get a chance to say anything, so I'll keep stum for the moment.
You've got thoughts, Dave. Share them.
Yeah. The returns from a strategy have an almost perfect inverse correlation with the amount of hype that it has at a given point in time.
Well, this comes back to my kind of Clapham Junction billboard indicator, doesn't it? Whenever you see a strategy or a fund being advertised, Clapham Junction station or AN of the railway station, then you know that the top is in and it's time to run a mile. And this would have been there. This would have been there back in the day, 2015,
not always immediately. It can't be like directionally. It's pretty correct, but it's maybe not on timing. Occasionally,
yeah.
You're absolutely right. Like the more things are once you're hearing about it, typically it's pretty too late for a strategy. I would have thought. But the marketing machine was fired up. They gathered up clearly. They gathered a heck of a lot of money.
The marketing machine was amazing. It was.
It's probably a bit before my time.
Not as good as equities. Better than cash, but when the market collapses, it will give you a positive return. Was essentially the marketing strategy. So one of the first absolute return type strategies that I think our industry really started to buy, because a lot of the hedge funds and things just weren't available to retail.
No, that's the point.
And hedge funds had a decent decade in the 10s, did they?
Yeah, all the way from kind of, you probably go from 98 onwards. I mean, the hedge funds had a good time through .com and through the financial crisis in the main, and it was a sort of bit of a new paradigm, wasn't it? The sort of absolute return. But you're right, they weren't available to retail investors. You had to be sophisticated.
The other big reason for launching it was obviously this was really the start of alternatives, wasn't it? Which is bonds give you nothing. We need to find something to give us bond-like returns.
You're selling the dream, aren't you? You're saying
you'll
get an element of the upside, we'll protect you against the downside. Also, there's the exclusivity angle, to JR's point of this type of product hasn't usually been available to you, Mr. Common Investor. What's not to love in terms of marketing? And
I'd actually strongly endorse what James just said there. The popularity of absolute return funds rocketed when bond yields fell. because the sales pitch was bonds yields are falling, you're not going to get returns from that bit of your portfolio, you need to find something else in the low risk sleeve of the portfolio, putting low risk in inverted commas there, because we know what's happened to those.
So we need to recreate the 60-40 and the 40 needs to be for something else.
Yeah, basically. And I think that was part of it, because bond yields from 2011, just kept falling, didn't they? 2015, 16, they were still going down. So I think that's a huge part
enough,
of it.
you'd have been better off staying in bonds.
You would have been better off staying in short-dated, high-quality bonds, James. Yeah.
Until a few years ago.
Oh, change the record, mate. God, Buff. Right.
But actually, I have to say, 1.4 billion as a closing value.
Still quite a big
That's
fund.
quite a lot of money.
I
mean, I
if my
expected...
maths is correct, it's less than 53 billion, but...
It is, but funds, I think, usually get closed when they... you often, funds have dwindled to 40, 50, 60 million. I think 1.4 billion sounds...
It's just death by a thousand cuts, isn't it?
Maybe it's just every month there's more redemptions and they just can't run the fund on those redemptions.
The other, I think we'll move on after this. So I think there's two final points. It got massive, and I think there's some academic data out there that says that investment strategies that become large struggle relative to more nimble, in inverted commas, peers. And actually their hit rate, so the success rate of their ideas that were profitable was 56%, which might not sound like a lot, but it's above the industry average of 50%.
Yeah.
So actually, their ideas weren't terrible, and that, I suppose, comes back to the size point. If you've got decent ideas, maybe you aren't able to execute on them because you're a massive strategy.
Yeah.
Who
There's
knows?
also this sort of idea of convexity. And what I mean by that is that if you're right more often than you're wrong, if your wrong decisions lead to greater losses than the winning ideas lead to gains, then you're still worse off, aren't you? Even if you've got more right decisions than wrong. I'm not sure if that makes sense, but hopefully it does. But if you've got a small number of wrong decisions, but they cost you a huge amount because they go down masses, versus your winners, which only make you a bit, then that's pointless. So
the classic example of that's private equity portfolio, right?
Oh yeah. Yeah.
So you get two that go absolute moonshots, and 98 that are
so
donuts.
private equity would have a very low hit rate. It would be much lower than 56%, right? But
I mean, that's what James Anderson, Scottish Mortgage, always said. He only needed 1 or 2 out of 10 to get right. He just
a couple of Amazons and you're away, aren't you?
Run them for a long way. And
it's easy, isn't it? Just find a couple of Amazons or Teslas, it'd be fine.
Easy.
SpaceX.
We'll see.
On the topic of looking for bargains, the UK market, I think it's not fair to call the sentiment around the UK absolutely despised. A lot of these names. One thing that seems to be entering the popular conversation a wee bit more is this idea of de-equitisation and reduced options for equity investors in the United Kingdom. What we've got on screen here, chart number 1, Alex, is the number of companies listed in the UK, in Germany and in the US, and all three have been going down in recent years, but none more so than the UK.
Amazing, isn't it?
Hughesy, what are your thoughts on this? Because you've been around for a while, and this has been a trend for a long time.
So I just wonder, I'm trying to see the date.
Let's zoom in a wee bit. Is that 86? No, it's not. It's 66.
Okay.
Yeah,
I was going to say more recently, I think cheap debt has to have something to do with it, and the number of privates and venture funds, and PE funds, because they can afford to run with these names for much longer.
We've had 16 takeouts this year so far during 2023, and only one IPO.
Yeah. So the chart shows the number of listed stocks, the number of listed companies in the UK has gone from 4,500 nearly in 1966 to 1,000 today, and that's down a straight line, isn't it?
Yeah.
It's not quite so bad in the US, but even in the US, from the year 2000, there were 8,000 listed companies, and now there are only 5,000. So that in itself is a massive fall. I mean, it's quite interesting. We talk about how valuations have gone up over time. There's a really simple kind of supply and demand thing here, isn't there? If there are fewer companies to buy, and more people are putting money into their pensions or their 401ks in the US or their ISAs.
Relentless bid.
Yeah, exactly.
There's not the supply.
You've got more you've got fewer companies to buy, and more people wanted to buy companies.
It hasn't really happened in the UK.
Hasn't helped the share prices.
Hasn't happened in the UK. No, but then on the flip side of the UK, you've had this kind of corporate pension scheme de-equitisation, haven't you? So particularly now that interest rates are a lot higher. Since the year 2000, the typical defined benefit pension schemes equity allocation has gone from 60% probably to 5 or something silly like that, and they've sold a lot of UK equities because they've immunised and they've bought a lot of bonds to hedge off and their kind of asset liability management thing, which I won't. I mean, let's not go there now. But pension funds, as in not you or my pension fund, but as in, for instance, the Call to Achieve Your pension fund, if there was one, looking after defined benefit employees, they have been huge sellers of equities, particularly in the UK, and that started around the millennium.
I think we said a few episodes again when Emma was on that actually the largest owner of UK equities is now foreign investors over domestic investors, which is quite striking. But I wonder if that UK listed, whether that includes AIM as well, because I think at its peak AIM had thousands of businesses.
1,000, didn't it?
Which
the listing requirements aren't the same, aren't they? And that's probably
one
of the reasons. Listing compliance.
Well, the other thing is cost. The cost of listing a business is so much higher today than it was a number of years ago. If you're looking at a small listing, it's still hundreds of thousands of pounds by the time you've paid corporate nomads, brokers, lawyers to put the IPO documents together. But I think the other reason I would say is people like us, it's much harder for us to invest in an IPO for multiple reasons. One is treating customers fairly, because everyone would have to do it at the same time. But secondly, there's not, because of what the FCA and regulation has done, taking that IPOs are typically in smaller cap, mid cap names, but regulation has pushed us away from investing in those names to large caps. So that's got to have an impact as well, I would have thought. It's interesting you haven't had the same fallout from the US. It just shows how unattractive people think the UK.
Well, yeah.
But then number of listings, we had 4,500. Germany at its peak was only 700. So
yeah, there's not been a lot of IPOs to pick from. ARM obviously have announced, I think back in March, that they're, or was that
NASDAQ?
that they're gonna go and list on the NASDAQ, which as a former UK listed company, it's a wee bit of a kick in the teeth for the UK. But that's the direction of travel at the moment. This is Robert Buckland in the FT to your point about interest rates. James, even with the latest interest rate increases, UK de-equitisers, UK companies can still borrow at 6% in the corporate bond market to buy assets on a stock market generating an earnings yield of 9%. Yeah. So there's a wee bit of a carry trade there. That's that's potentially what it still boils down to. But difficult to see how those trends reverse.
All this points to a re-rating of the UK market.
Well, it's just maybe supply demand. Oh, maybe it does. Who knows? Right, sentiment and price. We can't use the chart because we're too skint to afford the license. The NAAIM sentiment chart. We're not going to throw it up on screen, but the executive summary is that the market's gone down a bit, or it had done a couple of weeks ago, and hedge fund managers are selling equities again.
Amazing, isn't it? US stock market fell 5% in the early part of August, and investment managers, as in professional investors, people who probably ought to know better, got really bearish and sold a load of equities, and lo and behold, at the end of the month the market bounced back to being down only 1.5% in August, I think it was, the US market. So as we have said before, sentiment follows price, not the other way around. And it's a bit depressing because probably between all of us it kind of flies in the face of what good investment management is about, isn't it? Which is kind of buying when it's cheap and selling when it's expensive. I don't know. I mean, that's
or buying and doing very little.
Or buying just exactly. So
I think there's a lot of momentum type investors out there, aren't there, in the professional space that follow the popular names.
Yeah,
this comes back to the point about the hedge fund manager you see on CNBC who says sell everything. I mean, the point is that he probably doesn't have a 30-year time horizon. He's probably got quarterly performance targets. He doesn't want to draw down his portfolio more than 5% because that makes him look bad. His whole kind of raison d'etre is entirely different to you or my pension scheme, where if it goes down 20%, couldn't care less, can't access it anyway.
Well, the best thing about markets falling 20% is you get to buy stocks at cheaper levels
each month. Yeah, exactly. So, I mean, it's just kind of a rather depressing familiarity with the world these days and the world of investment.
I think you said a few episodes ago the average stock is held for 9 minutes in the US. Have you just said that?
I don't
The
know.
average holding period is 9 minutes.
I say a lot of things, Husey. I will say this again.
I'm sure
love a Pina Colada.
Honestly,
It's my fave.
honestly, 1,000 calories a glass.
Is it?
There's all the cream,
This
isn't
is
it?
like Guinness. This idea that Guinness is good for you. Guinness is having a bit of a renaissance again. It's trendy, isn't it?
Was
Well,
wholesome, I suppose.
Non-alcoholic Guinness is very tasty.
Is it? I've never had any.
Very
I've
good.
never
I mean, it's
had
fairly pointless, but it didn't taste too bad.
Never had it. There you go. That's the recommendation of the week. Non-alcoholic Guinness, if that's your inclination. We've had a bit of a go at the UK, so let's get some positivity in there. Fairly major revision to UK GDP growth, rather than being down by 1.2%. In 2021, the UK economy, the ONSA, actually grew by 0.6%. So that's a revision of 1.8%. Wholesale companies and the health sector produced much more than previously thought is the ONS's rationale for doing that. I'm not an economist, obviously. This is why it is so difficult as an investor / pointless / counterproductive to base any kind of investment views on what the economy may or may not be doing, because the data may be wrong. It may be wrong by a lot, and it might get revised 2 years down the line anyway. So the whole exercise is completely pointless for investors, in my opinion.
I wonder how much that's had an impact on UK markets as well, domestic stocks.
Well, it's completely killed the narrative of like the UK being the sick man of the world, because the UK has gone from being the worst performing economy in the G7 since the pandemic to like middle of the road, better than Germany and France.
How much that's held back business investment.
Yeah,
'Cause
exactly.
I know recently we've had a reasonable amount of business investment actually. We're still well below trend, but it's been a really good pickup recently. The problem is, as you say, as much as we know we should take the data with a pinch of salt and focus on the minutiae and actually from a micro level, it's a lot of big decisions are based on the data. You can't help but get distracted by it. And if the UK economy looks like it's struggling and growth is lacklustre, then it's got to have a major impact on business investment and in turn maybe UK equities. Maybe it's another reason. I mean, front page of the FT, wasn't it, on Saturday? Big article about it, and it does make you slightly cross that they can get the data so wrong when it's their job.
It was a weird period, I suppose.
It's true, but when it's having massive impacts on business investment, etc., it's
The GDP
frustrating.
numbers, do we think, have an impact on what investors actually do?
They shouldn't do, but if you're like,
I think
it's
they
kind of like
do.
this point about the UK equity market and global fund managers. But if you're a global fund manager, you are probably less likely to buy UK equities if all of the mood music on the economy out of that market is poor.
Yeah.
Is that, I mean, I don't think that's controversial, is it?
No.
No, and I think it's an argument
for
why-
international investors, because people look at the UK as 3% of MSCI World Index and think it's probably quite easy to ignore.
Yeah.
Plus the narrative around the UK is a bit rotten.
Yeah.
As a UK equity investor, you know the situation is a little bit more nuanced, clearly.
Massively, yeah.
But I think because trackers are such a major part of indices, people just sell the FTSE 100 tracker. And that in
Which
turn...
isn't particularly UK anyway.
No, but
It's
that in
80%.
turn has an impact on UK equity pricing. That's got to be... It's got to be part of it, hasn't it?
Yeah. But if you're like a global fund manager, global equity fund manager, you're probably looking at the likes of Diageo, Relex and Shell in the context of their sectors globally. So Diageo you compare to Brown-Forman in the States, or Brown-Forman makes Jack Daniels, or Pernod Ricard in France. And if you're looking at the oil sector, you put Shell up against Exxon and Chevron and Total in France. You know,
But,
so fun. But
I mean, you should do, but Shell trades at half valuation of Exxon.
yeah, but then if you've got asset allocators who are saying we want 3% of our portfolio in UK equities, and then they'll go and buy either a tracker or an active manager in the UK, and it's those guys probably will look at it and go, do I want to be over or underweight the UK? In the same way that we look at like Japan or the US and say, do you want to be over or underweight? And I guess most, this sort of negative mood music that we've been faced with for the last number of years on the economy probably has had an impact on those decisions.
Well, it has an impact on if we're making investment in emerging markets, which China's a big constituent.
Does or does not include the UK?
Emerging markets.
Well, I think it probably does.
We're probably not far off.
But you look at China and you look at the data coming out of China, and whether the data's right or wrong, that will influence whether you want exposure to that area.
Yeah.
We all know that the underlying companies can do something different, but momentum and sentiment drives everything short term. That's the issue.
Short term, yeah. We mentioned concentration in regard to the US a couple of times over the last couple of episodes. This actually caught my eye. I was quite surprised by this. It was in the Schroeder slide pack. 5%. Sorry, the top 5 stocks of the UK market make up 35% of the overall market. The top 10 stocks, it's 52%, which is much higher than in the US, Europe, Japan. Any other market really that you could care to mention. So if you don't
Hughesy's going to name the top 5 stocks in the UK, and then for bonus points if he gets number 6 to 10.
that's an ambush.
That's unfair.
To HSBC,
Astra,
Diageo,
Shell, and then maybe pass on the 5th because it's BP's close.
Quilter,
Unilever must be close.
Unilever will be
Unilever will be there because that's about 4.5%. BP and Unilever will be there or thereabouts.
Yeah, probably.
Diageo.
But if you're not, if you're UK Emma, for instance, being compared to the UK market, and the top 5 stocks are a third of your index, it's quite a big call to not hold
How
one
big
of those.
BATS?
It's tough.
BATS is about 3%.
But half as big as it was 6 months ago.
It was definitely Shell and HSBC, the top 2, and Astra, the top 3.
Well, Shell used to have 2 positions in the top 5.
They did. But it's come back to this point about if you're an active manager, if those stocks perform well and outperform the index, if you're an active manager,
Which happened last year.
I had it last year, which is why virtually every UK fund active
because it's very
underperformed.
difficult to get overweight a stock that's already 6% of the benchmark. Most active managers, as we've already talked about in the US, most active managers are underweight or at most equal weight the likes of Apple and Microsoft, which are big index constituents. Which may segue us neatly into the US market.
Yeah, that will. I'm actually not going to go there next. I'm going to go to this one, which I know we've talked a lot about US stock market concentration, but this is astonishing. The Super 7, which is infinitely preferable phrase to the Magnificent 7, which makes me want to jump out the window every time I hear it.
Magnificent 7.
I despise it, mate. I don't know why. It just makes me cringe so hard.
I love Magnificent 7.
Oh, mate, I despise it. Okay, why does the finance industry feel the need to make these little acronyms up? It's just embarrassing. Anyway,
Someone's sitting there with a Pina Colada thinking of acronyms.
The top seven, the Super 7 US stocks now make up more of the global stock market than the French, Chinese, UK and Japanese stock markets combined. Crikey.
Which do you want? Which of those 2 do you want for the next 10 years?
I'll take the right hand side.
Will you?
Yeah. I'm a value manager, John. You know me.
I'll take the right hand side as well for what it. But
It's the least shocking revelation.
more out of the right hand side is Japan, UK, China, and France versus the Super 7. And that's probably as much more from a diversification perspective, because on the left hand side you've got all tech plus a car maker, which is fine and it's been brilliant and they're great businesses, all of them, but
great businesses aren't necessarily great investments.
No, they're not. It's not a great portfolio, is it? Necessarily. Might be. Happy to be wrong.
No, you're absolutely right. These things are worth having, definitely. I think
not
especially
happy for you to be wrong.
You're not happy to be wrong.
No.
Sorry, easy.
Fine. I do not need those stocks on the left to carry on performing as they have been.
I mean, it's difficult to bet against them, but obviously, it's been difficult in the past to bet against businesses, and they've continued to grow and perform fundamentally, but the multiple hasn't kept up.
Yeah, they're amazing businesses.
Just you can see visually that both Apple and Microsoft remain bigger than the entire UK stock market, which is the green bar.
Yeah.
Green bit of the bar.
Actually, I just got my annual subscription from Microsoft, taking my £59 for my Office subscription.
Which you paid without hesitation.
I've got no choice.
No. Exactly.
Do you subscribe? Do you do the Pro on Strava? Are you a Strava Pro subscriber?
Might be.
Of course you are. I mean, that is the.
I can see
he would take the value bet here, and you're a Strava Pro subscriber. The least.
I can look at my segments.
I know you can. Mate, that's very unsurprising. Is it? Do you like it? I've been doing it for the last year and I've seen no tangible benefit. It hasn't made me any faster, which is very disappointing. Is that not how it works? You throw money at Strava and you take a minute off your 5k time?
I'm a data person. I love the data.
I know you are.
Live for the data. I'm not sure there's much data in running.
No.
And just for those listening, Hughesy's also wearing a Whoop watch bracelet.
I am. That's another subscription.
Yeah.
You had one of these, didn't you?
I did, but then I didn't. Then I realised that I don't need a small band and to pay £24 a month for it to tell me don't go out in the pints and try and get up for a run the next day. Transformational stuff, right?
The worst thing is when it flashes red at you and starts vibrating because it reckons you're about to have a heart attack. But
so I had actually on Whoop. So a mate of mine, who I won't name, is very into his training and things. He's very he's in very, very good shape, and he's got a Whoop, as you would expect. And we had a golf weekend at the weekend, and he woke up on Sunday and sent us a screen grab of his Whoop, which had declared him, I think, clinically dead. It's quite amusing. So on multiple expansion, you sent this through. I think this is from the Schroeder pack as well. James, all of it is multiple expansion rather than earnings coming through, but heard a stat during the week that if you exclude energy and one other sector which escapes me, probably mining,
yes.
Earnings in the States this year have been positive.
Yeah,
is that right?
So there hasn't been an earnings recession.
No, there has. We've had revisions down, haven't we, from estimates, but not an overall.
Well, they're down on 12 months ago, aren't
yes.
they? But maybe not calendar year.
No.
No,
interesting.
I don't think
so.
Something to come back to and talk about in future episodes.
Yeah, I think the multiple thing, but it's just.
I mean, there is some. Yeah, again, well, maybe we'll talk about it in the next few episodes, but there's a reasonable amount of chatter around multiples sort of getting to a low point, finding a trough level. Last 2 quarters they've remained fairly stable. That's quite a good indication that things are reasonable out there.
It would just be absolutely astonishing to me if we get through. If rates go from 0 to 5.5 and there's no hit to earnings.
But 18 months, we're around the 18-month time period of things of the initial rate hikes actually starting to impact the economy, aren't we?
Yeah, we'll see. Haven't seen it
Could
yet.
be a fun 6 months.
Well, we've been sort of expecting it for a while and it hasn't arrived, so people are still spending money.
Yeah.
Though there are some signs of weakness, and Johnny, you shared this with us. We had a JOLTS report, the job openings report in the US last week, didn't we? Which was initially quite well received. It's quite small there, the chart at the bottom, but historically what you see is the S&P tends to track job openings, so when more job openings are available, less job openings, isn't it? The market tends to go down because there's economic weakness. And they've sort of diverged a little bit in the short term because people think if the employment market is cooling, the Fed will back off, and that seems to be what's driving stock markets.
Bad news is good news.
Bad news is good news is the easy way of thinking about it. Bad news on the economy is good news for the market because it means the Fed will not keep putting rates up. So I think the market basically thinks that the Fed is done on rate rises, and all of the data that we've had in the last week or two, both on the job openings, and we had US and the headline unemployment data and non-farm payrolls last Friday, all sort of told a story of the labour market is kind of cooling from super hot, but still looks reasonably robust.
Yeah.
So if you believed in a soft landing, then all the data is kind of going your way at the moment. But then, I guess the flip side of that is all kind of proper slowdowns and recessions start with cooling from hot, right? Yeah. So this kind of idea could just keep going down, and all of a sudden you're in a recession. Right?
I don't want to sound alarmist, but for the economy to fall by a lot, it first needs to fall
start by a bit.
little.
Exactly. So that's exactly the point.
I think the big question is, when does bad news become bad news?
Well, and 100%, and you'll. I don't vividly remember in and around 06, 07, 08, but there was a sort of soft landing narrative being peddled around early 2008. 6 months later, Lehman Brothers blew up.
Well, that was
there was a sort of housing was contained. That whoever the Fed, Bernanke said the housing crisis, subprime was contained, and the economy was fundamentally strong. There was that sort of thing, and I'm not saying.
I think the economy was okay from a consumer and business point of view. It was that the banks couldn't stomach the rate rises as much as the consumer. And there's an argument this time round that actually banks and financial businesses, well, they can stomach higher rates than the consumer. So it's a different landscape. Of course, again, the biggest problem last time was banks just shut off finance and funding and loans to lots and lots of small and medium-sized businesses who could not get finance again, and they just rolled over. Whereas, again, this time, I think central banks have learnt their lessons, governments have learnt their lessons, but also banks are so much better capitalised that you're not going to have that situation again. Unfortunately, it is the consumer, and it's the people at the lower end that don't have the savings to fall back on that are going to get hurt the most. And that's the really sad thing about probably where we're headed. And of course, those people that took on too much debt with mortgages and things and can't afford the refinance now. But there'll be, that's a fairly small percentage. Yeah, I think so.
Yeah.
I don't think it's the end of the world, but we don't know the impact of these extreme rises yet.
No. If we do avoid a recession, one of the pockets that is going to absolutely rip is small caps. Johnny, you've shared a couple of charts on small caps.
Well, actually, it was Husey pointed this out on Friday in our little WhatsApp chat, how the Nasdaq, the US tech index was down on the day, wasn't it? But the Russell 2000, which is the sort of headline US small cap, was up 2% on the day. So there's a sort of, you get these kind of days where that sort of thing happens when most of the time the Nasdaq's been outperforming everything else. But small caps typically are more expensive than large caps because typically they grow faster, and if you've got a faster growing company, it should trade at a higher valuation than a slow growing company. That's kind of common sense. So as the chart shows, historically small caps have been at roughly a 20% discount to large caps over the last 10 years or so. And that that premium, 20% premium, and that has now gone to a very small discount, i.e. small caps look cheaper than large caps. Mainly because probably the large cap numbers are skewed by Apple, Microsoft, Amazon and Tesla in particular, and we know how big they are in the index. So when Tesla's on 50 times and Amazon's on 50 times, that does make a meaningful difference.
Some of them have cash on balance sheet, which higher rates is positive.
It's positive.
I think you've had these rolling recessions in the US almost, haven't you, across different sectors, which really impacts small companies.
A lot of that's to do with the COVID and the kind of hangover from all that, transport, logistics and inventories and loads of manufacturing and energy and loads of weird stuff.
But you've had smaller businesses are more impacted by cost of labour increases, financing increases. You can't finance as cheaply as a small company than a large company. So there's lots of reasons why this has happened, but history tells us small caps do outperform large caps on a long-term basis. And you can't argue that this isn't an attractive entry point. You might be wrong for a year or 6 months, or
hopefully not. For a while. But at Finley Park, the fund managers Finley Park, with whom we've had a close association as a firm for 25 years, since the Finley Park American Smaller Companies Fund was launched, when that fund has morphed over time into a large cap US fund over the last 15 years, and they've been buying what they call mid-cap equities, which in the US is between $5 billion and $50 billion. So in the UK context, that would be mid-range of the FTSE 100. That's what they call mid-cap. They've been buying a lot more of those companies, and in fact, that sleeve of their portfolio sort of makes up a much bigger proportion of their portfolio now than it has been for a long time, because those stocks look much, much cheaper than US large cap. And they've done a good job over 25 years of navigating, around the tech boom, they were owning small cap, which was cheap, and they did really well. They avoided blowing themselves up in the banks in 2008, and then they've moved to large cap through the 10s when Microsoft was their biggest holding for years, and they harvested the returns on that, and now they're moving back down the cap scale. So, I'm not saying they're right, but it's just interesting how that kind of, the valuation kind of ties in with this idea of going down the cap scale, potentially find some returns.
I noticed JP Morgan American, which we know is a growth value bias. they also have a small cap sleeve, and they've been increasing that small cap over this year, and actually that's done exceptionally well even against the S&P. So I think some quite good active managers are starting to dip their toe in again.
But I mean, if you get a recession in the US, small cap will underperform because small cap typically underperforms in a recession, and large cap is generally a bit more defensive. So,
but this recession has been coming for a long time. Do you not think that pessimism is in small cap already? It's just.
And if you strip out,
I just wonder how much more downside there is to small cap.
If you strip out the big seven, the market in general in the States isn't wildly expensive. I don't think.
No, it's not.
So the thing, it's a weird market because it's skewed a wee bit, but people, I've said this in the past, money has to go somewhere, and if you think there's a recession coming, you'll probably buy Microsoft and a 2.5% free cash flow yield, relatively safe growing business, relatively safe, rather than go and buy some cyclicals or some small caps, which most of them have been. I mean, look at the miners. The miners have taken a hammering.
No, I'd agree with that. Large cap quality tech in particular is a bit of a hiding place, and it is a bit a recession proof
utility
recession. Yeah,
even though
exactly.
it's not.
Even though it's not. But when Ben came on a few months ago, we did talk about the cyclicality of tech. If Quartichivia are doing, or another business are doing digital transformation program, and we're investing in loads of software, if we get a recession, the chances are that the likes of Quartichivia will postpone that investment for a year or two. So there is cyclicality in spending on IT. So Microsoft probably not totally immune from a recession, but the market thinks it's pretty immune.
Yeah. Okay. Great. Thanks. Done.
Was that?
I think we zipped through like 35, 40 minutes. What was that, Alex? Yeah, 40 minutes or so.
That's because we had a third person back.
Oh, it's easy here.
No, we're under our stride now, guys. Like we're absolutely zipping through that.
Well, I'm glad we've got the white shirt.
White shirt brigades.
Yeah. Should we do pink next time?
I only have white and pink shirts.
I'm white or blue.
Are you?
It's not blue shirt kind of weather though, is it? It's 28 degrees outside.
No.
I've got to go back to the desk. Johnny's celebrating on the rooftop of Coq d'Argent as usual, isn't it?
Oh yeah, on the Monday.
Pina Coladas on the rooftop.
Classic.
That's the name of this week. Thanks very much, fellas. Thank you for joining us, folks. As ever, if you got any questions, email me, david.henry@quiltercheviot.com. Otherwise, we will see you in a fortnight. Thanks very much.